This week, I want to add a little bit of color to the question I often get asked, which is, what do you look at when evaluating markets? So whether it's simple curiosity or for clients because it's going to help dictate how their money gets managed, I often get asked, what do you look at when you're evaluating markets? I think for a lot of people, it's just historical price movements. I hear all the time, oh, hey, I bought this. Oh, really? Why'd you buy that? Well, it was up 20% last year. Again, not really useful unless you got a time machine. We're trying to play what's laying in front of us. And when we're doing that, we need to understand, again, all the different forces and ways to evaluate, to at least give us the best possible chance to understand a range of outcomes. I think the two big points of confusion that I really want to put up first and foremost, because it's where I see people get confused, is one, understanding people's bias or just approach. There's three big approaches we'll cover today: fundamental, technical, and quantitative. The second is that a lot of times when you're hearing people talk, they're not as clear as they should be around what time frame are you evaluating. Are you really nervous or bullish about the market over the next 2-3 months? Or are you talking about more of a 12 to 24 month? Or is this outlook on maybe a various stock or asset class something that could be something that takes 5 years to play out? All those things are critically important. And again, I've heard a lot of people, both of whom make sense, both of whom I think have a really strong argument. They're just talking about different time frames in terms of how they see things playing out. To get to those three big approaches, each of which could probably be a series, fundamentalists look at things that you're probably more familiar with: macroeconomic data, earnings growth rates, valuations of stocks. This tends to be a more long-term thought. Eventually, we believe these earnings will be reflected in the share price, even if they're not today. It's more of an inevitable type outlook, as opposed to the second, technical, which tends to be a little bit more short-term in its thinking. It's looking at technical levels. These people believe they can look at historic price movements to deduce future price movements, whether that's through Fibonacci sequencing, Elliott wave theory, etc. The third and final, and probably the most dominant school of thought right now, is quantitative. This has really grown of late just because of technology, the ability to gather data and sequence it. Think of doing satellite imagery of parking lots, pulling credit card data in real time. You'd be amazed at the different information that people can glean to, again, take all that, put it into statistical modeling to interpret near to intermediate term behaviors. Why is quantitative so important in terms of looking at it? Well, 80 to 90% of trading, depending on whether you're looking at futures or intraday activity, is mathematical and computer based right now. And so these are the things that the machines are looking at when they're making the buy and sell orders that they do. How does this play into our process and our partners? Big point number two. We try to look at all of it. Clients have different time frames. The decisions we're trying to make have different time frames. And each one of these schools of thought, while some are just total adherence to one and only one, we think have their moments. As I said, they'll take different times in terms of market leadership and what's really driving the market just in general. They also play out, we think, differently just in terms of the time frames of the decisions that you're trying to make. Is this a decision about a position you want to hold for 5 years, or maybe something that's about dollar cost averaging into the market today and the rate at which you want to do it, or the timing of a rebalancing within a portfolio? So we go and we try to work with people who are at the best in each school of thought to be able to pull them together, to have conflicting theses and theories, to understand how all the different market participants might be thinking. And again, the result of that, we hope, results in better decision making. The other big reason we want to understand these three schools of thought is just to keep proper perspective. First and foremost, we want to be emotionally prepared. Think about your mindset, knowing you might be jumping into a cold lake versus laying in the sun and getting a bucket of cold water surprisingly thrown on you. Going to be different emotional reactions. We want to keep our emotions as steady as possible. And one of the ways we do that is by understanding what could happen looking at fundamental, technical, and quantitative type outlooks. The second one is just the complexity. No one of these schools of thought, in my opinion or in my experience, can explain everything. But if we can understand them and how each one is looking at any point in time, we can put together a better picture, both to, again, govern our decisions, as well as to be able to explain things to our clients. And lastly is just humility. When you listen to each of these people, when you look at the depth of the research, their approaches, again, the people we partner with, very process-oriented. Yeah, they often disagree, but that doesn't mean they're not smart. It doesn't mean their outlook might not play out, again, over different time frames. But keeping in mind, again, how fierce the competition is when you're talking about making money as an investor, and making sure your approach, again, is based in that place of humility as opposed to being led by an ego, smartest person in the room type of a mindset. I want to wrap it up by comparing and contrasting this from something that was almost 6 years ago to the date. I wrote a commentary called From Fear to Fear about people going from FOMO and chasing markets to panicking. At that time, the market, like today, was pretty volatile. You may not recall why. I didn't. It was a loosening of Iranian sanctions and an oil gut that was going to collapse the economy. Of course, the market went on to post a really strong year, and we wanted to, again, highlight 5 things at that time that we thought was a reason to stay the course. If we look at those 5 things today, one of them was yield spreads. Back then, still very much positive between the 10 and the 2-year treasuries. Now that's collapsed. Almost a full % over the last year, and that's got us watching. Again, if that inverts, that's classically been a sign of an impending recession. Second was commodity prices and input prices into the economy, then very low. I don't have to tell you about where inflation and commodity prices have sat here of late. Third was Fed. The Fed at that point was still very easing. Now we're about to enter into a tightening phase. That bears watching. Fourth was valuations. 2016, very low. We now sit in one of the top 10% most expensive markets. Fifth was leverage. That remains pretty positive. Then consumer leverage was low. Consumer leverage today is still pretty low. You mix all this up with some technical and quantitative things like volatility discounts, implied volatility discounts, technical trends for markets, volatility ranges, and mix it all together. Where does it have us? Cautious. So unlike 2016, where we said, hey, don't worry at all, now we would just tell people, don't be fearful, but be cautious, be mindful around how, again, the next 3 to 16 months will play out. This is what we do for you every day, every week, to make sure we can be the best we possibly can be for you. If you're a client, thank you so much for that honor. For all of you, thanks for your time.